Welcome back to another episode of Fire Trail, the show that's all about helping you achieve financial independence and retire early. I'm your host, Xiao Yu, and today I'm super excited to dive into a topic that's incredibly relevant for anyone looking to grow their wealth, investing in the S&P 500. First, let's talk about what the S&P 500 actually is. It's a stock market index that measures the performance of 500 of the largest publicly traded companies in the United States. The S&P 500 represents a diverse range of companies across various sectors. For instance, you have tech giants like Apple, healthcare companies like Johnson & Johnson, financial institutions like JP Morgan Chase, and retail giants like Amazon. This diversity helps spread risk because if one sector faces challenges, others might perform well, balancing out the overall performance. Now, why should you consider investing in the S&P 500? Well, historic performance is a big reason. Over the long term, the S&P 500 has shown remarkable growth. Sure, there are ups and downs, but if we look at the historical data, it has consistently trended upwards. The average S&P 500 return for the last 10 years is 12.39%. Over the last 20 years, 9.66%. The last 30 years, 9.86%. And over 50 years, 10.75%. Those are incredible returns. Another reason to consider S&P 500 is diversification. Diversification is like having a safety net for your investments. When you invest in the S&P 500, you're spreading your money across 500 different companies that represent various sectors of the economy. Imagine you own stock in a single tech company, and suddenly the tech industry faces a downturn due to unforeseen circumstances. Your entire investment might take a hit. However, by investing in the S&P 500, which includes tech companies along with healthcare, finance, consumer goods, and more, your risk is diversified across multiple sectors. If one sector faces challenges, the positive performance of other sectors can balance out the impact, potentially reducing the overall risk to your investment. For instance, consider the dot-com bubble burst in early 2000s. Many tech companies experienced a significant decline in their stock prices. However, because the S&P 500 consists of companies from various industries, the overall impact on the index wasn't as severe compared to investing solely in tech stocks. Diversification isn't just about reducing risk, it's also about maximizing opportunities. While some sectors may face challenges, others might be thriving. For example, during economic downturns, consumer staples or utility companies often remain relatively stable because their products and services are essential regardless of economic conditions. By being invested in a diversified portfolio like the S&P 500, you have exposure to various industries that can perform differently under different market conditions. Warren Buffett, one of the most successful investors, famously said, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." While Buffett advocates for concentrated investments when one has extensive knowledge, for many investors, having exposure to a broad range of companies through an index like the S&P 500 provides a level of risk mitigation that aligns with their investment goals and risk tolerance. So, when you invest in the S&P 500, you're essentially spreading your risk across different sectors, benefiting from the collective performance of various companies and potentially reducing the impact of market volatility on your investment. It's an essential aspect to consider when building a robust investment portfolio. Remember, diversification doesn't eliminate risk entirely, but it can help manage and mitigate it. Always conduct your thorough research or seek advice from financial experts before making investment decisions. Furthermore, investing in the S&P 500 is also incredibly accessible. Here are a few key aspects that highlight its accessibility. Number one, investors can access the S&P 500 through various financial instruments, such as index funds and exchange traded funds or ETFs. These investment vehicles are specifically designed to track the performance of the S&P 500. They allow individuals to buy shares in the fund, which in turn holds a proportional stake in the 500 companies listed in the index. This means you don't need to individually purchase each of the 500 stocks, simplifying the investment process. Number two, many S&P 500 index funds and ETFs come with relatively low expense ratios. These fees are typically lower compared to actively managed funds because they passively track the index without requiring active management decisions. Lower fees mean more of your investment capital goes toward purchasing shares in the index, potentially improving your overall returns over time. Number three, most brokerage platforms offer S&P 500 index funds or ETFs, making it easy for investors to access the index through their preferred investment platforms. This availability allows investors to include the S&P 500 in their investment portfolio alongside other assets they might hold. Number four, some investment platforms offer the option to purchase fractional shares of the S&P 500 index funds or ETFs. This means investors can buy a portion of a share, making it accessible to those who might not have the capital to buy whole shares outright. This feature allows for more flexibility in investing smaller amounts regularly, contributing to the accessibility of the index for a wider range of investors. Number five, many retirement accounts, such as IRAs and employer-sponsored 401k plans, offer S&P 500 index funds as part of their investment options. This inclusion enables individuals to invest in the index as part of their retirement savings, aligning with long-term financial goals while enjoying potential tax advantages. These accounts offers Overall, the accessibility of the S&P 500 makes it an attractive option for investors of varying financial backgrounds and experience levels. It allows for easy entry into the stock market while providing exposure to a diversified portfolio of some of the largest and most established companies in the US economy. Finally, it's crucial to emphasize the importance of a long-term perspective when investing in the S&P 500. Short-term fluctuations are normal, but if you're in it for the long haul, history shows that the S&P 500 has provided solid returns. For instance, during the market crashes like the one in 2020 due to the pandemic, those who held onto their investments rather than selling amid panic saw recovery and subsequent growth. The S&P 500 had a total return of 18.4% in 2020 and 28.71% in 2021. Moreover, a long-term perspective aligns with the fundamental principle of compound interest. By reinvesting dividends and allowing your investments to grow over time, you benefit from the compounding effect, where your returns generate further returns. This compounding can significantly amplify your gains over the long run. Additionally, a longer investment horizon allows investors to better withstand market volatility. Short-term market fluctuations can be unnerving and may tempt investors to make impulsive decisions like selling during a downturn. However, a long-term perspective enables individuals to focus on the big picture and stay committed to their investment strategy, potentially avoiding knee-jerk reactions that could harm their portfolios. Finally, investing for the long term aligns with various life goals, such as retirement planning or funding future projects. By staying invested in the S&P 500 over an extended period, investors have the opportunity to accumulate substantial wealth that can support their financial aspirations. In essence, adopting a long-term perspective when investing in the S&P 500 allows individuals to harness the power of time, compound interest, and the market's historical upward trajectory to potentially achieve their financial goals. To sum it up, investing in the S&P 500 offers a straightforward way to participate in the growth of the US economy. It's not about timing the market. It's not about trying to time the market. It's about staying invested over time and letting the market work for you. As always, before making any investing decisions, consult with a financial professional for personalized advice. Thank you for turning into this episode of Fire Trail. If you enjoyed this episode, don't forget to subscribe to the podcast and leave a comment. Thanks for listening. This is Xiao Yu, wishing you all the success and happiness on your financial journey.